Howdy, folks. Welcome once again. Today's discussion centers on 3 mistakes people make when transferring their 401ks to IRAs. There are pitfalls and tripwires all over the place. And so when folks leave a job, typically, and it's not always the best solution, really. There's a lot of things to look at, but they want to take their 401k with them. Often they look at moving it to an IRA managed by an advisor or themselves. And often you have options, by the way, to transfer that to your new employer if there is one. And sometimes you're better off leaving it in the existing 401k, but that's grist for another podcast. Today we're talking about the 3 mistakes that most people make when they are transferring their 401ks to IRAs. And the first one really that doesn't occur, I'm sure, to most of you, is missing a critical deadline. Because what happens, Anna, when somebody transfers to an IRA, and they direct their HR person to what are the mechanics typically, or what are the pitfalls?
Yeah, so if that check isn't made out properly, it's not written as a rollover check. Sometimes taxes can be taken out, and you may not realize that. So you've paid 10% or whatever it is to the IRS. You deposit your portion into your IRA, and you don't get the full value of the rollover. Also, I've had clients where they just cut a check from the 401k to their name, meaning, full balance, meaning to put it into their IRA, and they don't do it within 60 days. And all of that counts as income for them.
But plus, do they avoid the 10% penalty?
Exactly, they don't. So then
Right.
Penalty too.
So that's a critical point. And according, again, this is dropped into the Wall Street Journal article. If you don't tell your administrator or your HR people where to send the funds, whether intentionally you just forget or they forget. I mean, these are not tax lawyers either. That you'll just get a check in the mail made out to you, as Anna said. And if it happens that way, which happens far too frequently, you had 60 calendar days to put that money into an IRA or into a traditional IRA, or IRS will treat the withdrawal as taxable income. And you'll have to pay the income. That income will stack on top of all your other earned income or whatever that year. Plus, you'll have that 10% penalty. And I'm telling you, it is nearly impossible to get that back once it happens. This is a real big danger. And not only that, you will also probably get your check with the taxes deducted. So if you took $100,000 out, and I think that the typical withholding is 20%, right? Mm-hmm. You'll get $800,000. If you put $100,000 out, you'll get $80,000. But still, then you're still going to have to come up with the tax money, I think, if it's additional, right?
Yes.
Otherwise, you'll get penalized on that.
Exactly.
Yeah. Anything that you care to add to that, Professor?
It's a costly mistake. There's some costly mistakes that we definitely have to be cognizant of and pay attention to. Otherwise, you can end up with a very high tax bill.
So that's be careful, all right? And it's one of the reasons when we do the IRA rollovers for our clients and for new clients, we're very careful to describe the procedure. How what do you do when you get one of these?
Yeah, so I always call with the client to the 401k provider. They have to be authenticated, give permission to speak to me. And then basically I'm making sure that the checks are made out properly, proper account numbers, titled properly. When they review that information, making sure it's correct. That way we know when the checks are coming, so they don't just get kind of lost in the mail, and we know they're made out properly and that they're indicated for the IRS that it's a rollover.
Yeah, you got to check every box, and then things go smooth as silk.
Mm-hmm.
And always follow up. Make sure you always follow up, because sometimes they just kind of get lost in the shuffle, and these checks, if you lose them, lose the check, and 60 days goes by. You're on the hook for the taxes on that amount. So
great point, Lou. You really want to follow up because sometimes the HR department may screw up. They may make it out just to your name.
Yeah.
And instead of the transferee institution where it's supposed to go, and if that happens, then it'd be taxable to you. And gee whiz, if you don't get the check in the mail, you're going to forget about it. Probably assume it went off properly. Mm-hmm. If you're not working with an advisor like us that's on top of it. And then, once that 61st day comes, you're screwed.
You get that tax bill in the mail. Next thing you know, you're liable for some taxes.
Yeah, once that check is cut, it generates a 1099-R to IRS automatically. So it's not as if somebody's telling IRS or you're going to tell them they're looking for their money right away. And if they haven't withheld the funds, even they screw up the name, it becomes the disaster just compounds. So make sure that you carefully check the box. The second big mistake that people frequently make is missing out on the so-called rule of 55. Who would like to elucidate us on the rule of 55?
So do you want to?
I can. So if your funds are within a retirement plan like a 401k or 403b, you have some extra options if you did want to retire early and take distributions before 59 and a half. If you roll the funds into an IRA, you're going to lose that option essentially. And what it does is you can take those withdrawals. They're still taxed, which is fine, but you don't have that 10% penalty.
Yeah, and some people use that kind of as bridge financing. So if I'm terminating and expecting a job, but I'm not going to get a paycheck for 2 or 3 months, to be able to take money out of the 401k and avoid the 10% penalty, you got to pay tax on just like a paycheck, but to be able to use those funds to live until a new paycheck kicks in. So, with the rule of 55, as the provision is known, the IRS allows you to make withdrawals from your 401k or 403b without paying the usual 10% withdrawal penalty. Now, you still would pay taxes, as Anna had mentioned earlier. When you withdraw, you'd still avoid the 10%. So it kind of gives you bridge financing until your next paycheck kicks in. And the third big mistake that folks make with IRAs is when you invest in company stock inside of a 401k and then you leave. You really have a choice, and which is a net unrealized appreciation election. And this is kind of arcane. Either one of you guys familiar enough with this to talk about it? Anna? So basically, this is what the deal is. If I leave that stock and I transfer it to an IRA, another 401k, it'll continue hopefully to appreciate, right? Assume that it does. But then what's happening? What's the tax treatment of everything in a traditional 401k or IRA? What's the tax treatment?
Deferred.
Yeah, but what's kind of a tax rate?
Income tax rates.
Well, it's ordinary income, right?
Yeah.
You're your highest bracket. So what net unrealized appreciation election does is let you take the stock out and pay tax on it right now, and then henceforth capital gains rates apply. So if you're in the 40% bracket and I've got $500,000 in company stock and I take it out and pay the tax, then what's left, well, if it continues to appreciate, I now only have the capital gains rate at 20% to pay instead of presumably 40%. And that's something that you're going to want to model pretty well to make sure based on projected brackets and so forth. But it's an arcane point, as you notice that even our super CFPs, this is not something that we come across all the time. But depending on person and the fact pattern, it could be worth an awful lot of money. Any concluding remarks? Any other mistakes, super CFPs, that you see folks typically make when transferring their IRAs to 401ks IRAs besides buying annuities?
One that has come up like once or twice for me just in my career is a client who maybe is retired, working part-time, and qualifies for their employer plan and is of RMD age. And what I've seen them do is they just kind of they roll an old employer plan into an IRA, so they're forced to take their RMDs out of that. Where if they'd been working with a professional, you could have suggested to put it into their existing 401k and not have to take RMDs. So sometimes just talk to a professional and make sure
that knows what they're doing.
Knows what they're doing.
Don't. I mean, tax law is incredibly complex and broad. And just to make sure that that we're clear about what you were saying, so I leave ABC company, I've got a 401k, and I'm 72 years old, right? If I move that money into an IRA, it becomes immediately subject to required minimum distributions. Got to pull so much out, pay the tax on it. If I leave it in a 401k, even a previous employer,
it has to be your current employer, but
so
you could roll it.
So I got to roll it to my new employer, and many of them will permit that. And then the RMDs are not required. So long as I'm employed and the money is in a 401k or actual qualified plan, not an IRA, the RMD clock has to start ticking.
No, absolutely, and that goes. Even if you're a business owner, if you're able to have a individual solo 401k, same rules apply. You can defer your require minimum distributions by keeping that money in the 401k as
By
opposed to
setting up your own plan for the company.
correct. Absolutely. Yes.
Any other besides, you can even use the annuity card if you want. Any other typical mistakes that you've seen in your practice?
Well, yeah, I've seen, speaking of IRAs, I've also seen a lot of people make the mistake that or get sold on an annuity where they put their roll their money into a 401k or 403b funds into an annuity, lock it in there, and they kind of get spoon fed the amounts and
also get whacked majorly on commissions and frequently on fees too, which are very difficult spot. And that's really typical in a lot of workplaces where you've got retirement experts that kind of work the large group, and they say, well, gee whiz, I'm fully trained on the federal retirement system and so forth, and but they're really looking to sell annuities, which can be extremely expensive. And once you're in, you ain't getting out in most cases without paying a massive surrender charge. But that will probably run a little bit of overtime for this, so we could gush on all afternoon, but we'll have to save it for next time. Until then, thank you so much for watching. With my Super CFPs, this is your Wealth Dr. Jeff Camarda. Thank you so much for watching.